Okay, I'd like to take this opportunity to welcome everybody to today's event. This is our Model ETF portfolio session. It is Monday, July 12th. You got John Hopkins here, and Tom Bowley is going to jump in just a minute to get this thing started. I want to welcome anybody who's new to Earnings Beats. Thank you for taking the time to stop in and check us out. Thanks so much to our great seasoned veterans for supporting us, some of you for many, many years. This session will be recorded. All of our webinars are recorded, so if you become a member, you get access to all of our webinars. And there's a lot of great information. Today is open to everybody who's part of the Earnings Beats community. That includes our paid members, people who subscribe to our Earnings Beats Digest. And wanted to let you know that tomorrow we have a members only event. It's going to be a good one. It's our Options Max Pain webinar, where Tom's going to take a look at the market and try to give you some insights as to where the major indexes and some stocks might move between now and options expiration Friday. Always a great event. Open to all members, including trial members. So if you're thinking about giving us a try, this would be a good time to do it. A couple of great events coming up over the next week as well. You sign up for the no-cost trial. Just go to our website and you'll see you can sign up. Doesn't cost you anything. You can jump in tomorrow's event, which I think will be great. Anyways, we got a great crowd assembling here. I know Tom's got a lot of good information to share, so I'm just going to see if he's ready to roll.
I am ready to roll. Good afternoon, everybody.
He's ready to roll. How's it going?
It's not too bad. Pretty hectic last few days. Got a lot of new stuff out to our members, new chart lists and so forth. So, and busy week as far as webinars go this week and into the early part of next week. So got a lot of great information to share. And I think a lot of folks will enjoy this one tonight.
Okay, well, I'm going to go ahead and step aside. You get started and I'll be lurking in the background.
All right, sounds good. Let's go ahead and just start with that agenda for tonight, for this evening. You can see introduction. Welcome, everyone. We're going to go through key factors, some of the things I think that are pretty meaningful. If you're trying to put together an ETF portfolio, maybe some of these things will just jog your memory, as you put together a portfolio of ETFs. Then we're going to get into themes. So at Earnings Beats, what we do with our model ETF portfolio is we adjust them, or we adjust the portfolio every 90 days. So depending on what's going on in the market, we kind of try to follow momentum. We're not trading individual stocks, but ETFs hold individual stocks. And as you'll see tonight, when we get into the ETF Analyzer at the end, when you look for some of the best performing areas of the market, you'll definitely see some themes that are coming out, things that have been leading the market recently, where some of the momentum is. And that's the whole idea, with us, is we're trying to look for that momentum that hopefully would carry us for the next 90 days. We're not always going to go after the hottest thing that just happened last quarter, because that's not always the hottest thing next quarter. But there's a process, I think, that we can go through in trying to come up with a number of ETFs to cover different areas of the market. And so I think you'll find it pretty interesting, and hopefully it'll just make some really good common sense, a lot of the things that I talk about tonight. And of course, that final point there, the ETF Analyzer, this is something that was developed here at Earnings Beats. We go through, we put together a strong ETF chart list. And once we have that together, we take all of those ETFs that are in that strong ETF chart list and we put them on an Excel spreadsheet. And then we break it down. We break down each one of those ETFs for our members. And I'm going to show you what it looks like later. But we break all these down for our members by the 11 sectors, the 11 sector ETFs. And then we also have another tab where we provide the top 10 holdings, along with the weighting of each individual stock within each ETF. so that you can get a really good sense of not just the theme or the area that an ETF is invested in, but how highly concentrated is it? Is it really diversified, or is it concentrated in just a few names? All of this, I think, is part of just a prudent plan to try to put together a portfolio. So that's what we're going to go over tonight. So why don't we go ahead and start with key factors. So the first factor, and I'm going to bring up a chart here for you. Let me see if I can get this up. So the first thing I want to start with, and I start many of our webinars with this because, as many of you probably know, I'm a bull. I think this market's going a lot higher. I said it a year ago. I said it 3 years ago. I said it 5 years ago, and I'm going to keep saying it. We are in a secular bull market. The market is ignoring most short-term warning signs. I mean, yeah, we go through little periods of correction, or even in the case of the pandemic and the trade war, we went through cyclical bear markets, but it's all part of a secular bull market. And if you don't understand the difference between secular and cyclical, secular means long-term. So I believe this is part of a long-term bull market in US equities. Cyclical means short-term. So you can have short-term bear markets within a long-term bull market. And I think that's what we saw with the pandemic. Very similar to the 1987 market crash, if you've been investing for decades. That was part of a secular bull market, but it was a cyclical bear. It was really bad while you were in it. But if you just blinked over a course of maybe a year, you wouldn't even know it happened. And that's really
Tom?
what happened here with the pandemic. Yeah.
Tom, if you're trying to show a chart, would you
I
see
haven't
the
shown it
agenda?
yet.
Oh, sorry. Okay.
No, I was just kind of talking, but I was kind of leading up to the first chart I want to show. And that is, I'll bring that up now. And that is my 100-year chart. And I think this is really an important chart from a big picture perspective. This isn't going to tell you what's going to happen next week or next month or next quarter, but it does give you a pretty good sense of the long-term current, if you will, of the market. So if you think about, when you're out in the ocean, you're trying to swim. If you're trying to swim with the current, you can swim a whole lot faster than if you try to swim against it. And so when we get into these secular bull markets, stocks are swimming with the current. Most of them are going to go higher. And some of them are going to go a lot higher. But you can look through these long-term periods. I've put the secular bear markets, I've shaded those in red. And then these others, you can see these long blue directional lines. These are secular bull markets. We've been in this current one for about 8 years. Now, some look back and say, well, no, it was 2009. So we've been in it 12 years. The way I calculate these secular bull markets is I don't start the clock until we make the breakout to a new high. So it doesn't start in 2009. You don't know if we're going through this double top. So you can really have some pretty nasty head fakes. If you just look at the trend that we had from 2003 to 2007, you just said, okay, we're in a bull market. Well, no, we weren't. We were in a cyclical bull market, but not a secular. When we broke out in 2013, that became part of a secular bull market. And what I wanted to share with you while you're looking at this chart, I want to read you some numbers, because this is part of planning and what you want to do with an ETF portfolio. Let me tell you what the 11 sectors have done from April 10th, 2013, which is right here on this chart. That's where we broke out above this double top. It was on April 10th, 2013. Since this time, the S&P 500 has gone up 176% through today's close, July 12th. 176%. 6 of the sector ETFs have outperformed the S&P, and 5 have underperformed. Now, when I do anything in the market, my goal is to outperform the S&P 500. If I can't do that, then I could just get into the spider and I could save a lot of time and just, do something else, go golfing, hiking, whatever, tennis, beach, name something that you like to do. That's what you could be doing. Just put your money in the S&P 500 and not worry about everything else. The S&P 500 is going to combine the really good areas of the market with the really bad areas of the market. You're going to get an average. So think about a report card. If you're happy getting a C, in school, then, you just kind of muddle along. But if you want to get an A, you got to work a little harder. And that's the way the stock market is. If you want to beat the S&P 500, you got to work a little bit harder at it. Let me give you some of the numbers. So the S&P 500, 176%. The XLK technology is up 462% versus that 176, 462%. That's easily the best performing sector ETF, technology stocks. When the market is moving, when the current is carrying stocks higher, you generally want to overweight technology. Doesn't happen all the time. We saw it back in February to May this year. Technology was really struggling. Many of the growth areas, software, semiconductors, we had some of those in our stock portfolio. Trust me, I know the growth stocks, the technology area was not good. But over long periods of time, technology tends to do very well during secular bull markets. So you've got to keep that in the back of your mind when you're putting together a portfolio. Communication services, 322%. Consumer discretionary, 281%. I'm giving them to you in order. Healthcare, 211%. Industrials, 190%. Financials, 189%. Those are the 6 sectors that have outperformed. Now, if you notice one thing, 5 of those 6 sectors are aggressive sectors. When we're in a secular bull market, you want to be weighted mostly toward the aggressive sectors because they tend to outperform during strong periods when the market performs well. Now, going further down the list, remember, S&P 500, 176%. Materials, 151%. Real estate, 141%. Consumer staples, 116%. Utilities, 114%. Energy, minus 9.5%. Over the last 8 years while we've been in this runaway bull market. Energy has actually gone down. Even though we've had a nice little run recently, we're still down over the last 8 years in energy. Now, energy and materials, I'll tell you, are much more dependent on the dollar. If the dollar's weakening, you can have bull markets and bear markets with the dollar going up. You can have bull markets and bear markets with the dollar going down. I remember, I think it was back in like 2006, 2007, everyone got upset because, the dollar, I think, well, the dollar was really weak back, I think, in 2002 to 2008, something like that. Maybe might be off just a little bit. But when the dollar was weak, the stock market was going higher. And so I remember a lot of folks writing about it saying, well, if the dollar keeps going down, the market will go up. And I'm thinking that has nothing to do with it. The dollar can go up while the stock market goes up. If you don't believe me, just look at the chart the last 10 years. Dollar's been going up. So has the stock market. So sometimes I think too many analysts have short-term memories and they just see what's working now and they figure that's just the way the market is. That's not the way the market is. But it is important to understand the relationship between the dollar and the stock market, because if the dollar is strong, it's going to really put pressure on a relative basis on materials and energy. But if the dollar is weak, then those are 2 areas you really want to consider. Over the last year, the dollar's been weak and we've seen energy and materials do well. So the dollar is another one of these key factors that we have to keep in mind as well. But anyway, I just wanted to show you the secular bull market and the fact that it started in 2013 and just give you a little history in terms of percentage gains. Now, while the S&P 500 went up 176%, the NASDAQ nearly doubled it, 346%, while the Dow Jones only went up 136%. So one of the takeaways from this is if you're someone who's very conservative and you're in a bull market, you may not be interested in technology and all these other areas because you might think, well, I can't take the pain, especially like what we saw, like I said, in February back through May of this year, when the growth stocks were struggling. Technology, we were in a bull market, secular bull market, but technology went through a really rough 3-month period. Well, one way to kind of avoid having to take that kind of risk is just be in things that are more conservative. You could be in defensive areas. They've gone up. They just don't go up as much and usually fall quite a bit short. So if you're looking at the S&P 500, you want to be a little bit more conservative. The Dow Jones might make sense. You know, those 30 stocks, they're behemoth companies. They don't move like these tech stocks do, you know, the smaller mid cap tech stocks. But then if you're maybe a little younger or you're willing to take a little bit more risk, you could be looking at the NASDAQ and you could be looking at these aggressive areas of the market. You should be overweighting when you put together your ETF portfolios. In my opinion, I think over time they'll do better. Just my opinion. Feel free to disagree. Check with your own financial advisor. We always say here at Earnings Beats, we are not registered investment advisors, so we cannot provide financial advice. We're not licensed to do it. We educate. Everything I'm showing you here tonight, it's education. It's things I've learned over the years, just passing it on. All right, so we've seen the 100-year chart. You know the bull market rules. Aggressive stocks tend to lead. Went through all that sector performance since April 10th. Talked about the dollar. Well, a couple other things to think about. Number one, how diversified do you want to be? Are you somebody who needs to have, 15 ETFs? Because keep in mind, ETFs own anywhere from maybe 20 or 30 stocks up to maybe as many as a couple hundred or several hundred. So do you want ETFs that spread money around to 500 companies like the S&P 500 with no one company, well, S&P is probably not a good choice, but maybe like the Russell 2000, where you've got a lot of smaller companies and no one company is, overwhelmingly directing the ETF one way or the other? Or do you want highly concentrated ETFs where you know which stocks are driving those ETFs so that you can monitor it? Personally, if I'm in an ETF, I want to be able to track it a little bit. I want to know what are some of the stocks that are really driving that ETF? Because if those stocks start to break down, chances are I want to be out of the ETF. That's my strategy. That's the way I would approach it. So anyhow, diversification is pretty key in trying to set up a portfolio. All right, so went through some of those factors. Let's talk about themes, because to me, as we go through this every 90 days, themes play a big role in what we're going to do. The first thing I would do when we're talking about themes is go in and look at our relative strength chart lists. One of them we have is sectors, the other are industries, and just get a sense of what's leading the market. I mean, you can flip through these very quickly and get a sense. I said earlier, technology from February through May was not doing well. Here's their relative strength. Went down through March, popped for a little bit at the end of March, and then took another tumble over the next 5 weeks. This was a pretty rough 3-month period for technology. But look what's been happening the last 2 months. Technology coming right back. You can see here just over the last 2 years, the relative strength of technology. And if I go back even further, let's go back to eight years. So we can get back close to the April 2013 timeframe. Here was, back in 2013. We go through periods where technology doesn't do very well, but look at the long-term picture. If you're overweighting technology over the last 8 years, you're beating the S&P 500. It's going to be really difficult to lose to the S&P 500 if you've been overweighting with this kind of outperformance. And then down the bottom of these charts, I have the absolute performance. So this is just showing us what the XLK is doing. This is showing us what the XLK is doing relative to the S&P 500. They don't always go the same direction. Look back during the initial stages of the pandemic. Technology stocks fell from, the XLK went from 100 down to 70. But the relative strength went up. How can that be? Well, the S&P 500 went down more than the XLK. So relative strength improved, even though price action went down. That's the difference. So it's always important, in my opinion, to continue to follow relative strength. So we can go through and just look, okay, technology's gotten stronger. Now we'll just go back to the 2-year chart. Consumer discretionary making a move back above its 20-week relative EMA. It was weak from February all the way through the end of May, but it now has started to turn up. And if you know anything about the consumer discretionary ETF, the XLY, which is what this tracks, you know the largest holding is Amazon, which just made a big breakout here over the last week or two. So, you know, when you look at this, you have to know a little bit about the stocks that are inside in order to be able to really cast an opinion on whether or not you want to own an ETF. Consumer discretionary, the big names are Amazon and Tesla. If those two companies, and Tesla's starting to strengthen, Amazon's broken out, if those two companies do well, it's going to be tough for this XLY to turn back and roll back over to the downside. As Amazon's been strengthening and as Tesla's been strengthening, you can see the XLY has been strengthening. So it's not just buying an ETF. You need to know what you own. And that is what we talk about all the time when we talk about ETFs. Know what you own. Don't just, hear about an ETF and say, oh, it's done really well. Let me just go ahead and put some money in this one. Then I'll pick this one over here and then this one over here and then these two. Now I've got a great portfolio. I got 5. For all you know, you might have the same top holding in all 5 ETFs. You may be way over concentrated, even though you think you're diversified. So always know what you own. But we could go through here, and this is what I do, and this is what I'll be doing next week for the actual model ETF draft. When we announce the next group of ETFs that we're going to have in our portfolio, I'll go through and I'll look, okay, what areas are outperforming? When I start setting my mind on where I want to overweight, I'm going to pull up the ETF Analyzer later and it'll show you the sector weightings of each group within the S&P 500. So for instance, the technology area, the XLK, is roughly about 24% of the spider. But if I really like technology, when I put a portfolio of ETFs together, it might not be a bad idea to have 30% of my ETFs in the technology area, or maybe even 35%. Or if you're really aggressive, maybe 40%. And you might want to underweight some of the other areas that I talked about earlier that don't perform as well during secular bull markets. So there's communication services. Here are your industrials. Now, the last month and a half, even 2 months, you can see industrials have weakened again, but the overall trend remains higher. That can mean different things to different individuals. Some who are only looking at the most recent might look at this and say, industrials are underperforming right now. I don't want to be a part of them. Or I just want to make sure I'm underweight. Others might look at this and say, well, I'm a value person. I like the fact industrials have pulled back. It's still part of the aggressive sectors, and maybe I want to overweight a little bit. Everybody's different. Financials. And when we go through this next week, I'll explain why I'm picking certain ETFs, and I'll go through all of this. Feel free to disagree with me. I mean, again, it's just my opinion. It's not any kind of guarantee. Financials, 10-year Treasury yield's been coming down, although it's trying to reverse back up in the short term. But as a result, we've seen financials underperform, though we did get a little bit of a pop today. Healthcare. This is the one defensive group that's outperformed the S&P 500 since back in April of 2013. But the last 14 months or so has not been kind to this group. Healthcare continues to struggle. One of the things I tend to look for, I like to see the PPO above the 0 line, that's relative PPO. And I like to see the relative price action above both of these moving averages. And I like to see the 20 above the 50. That's the configuration I like to see. PPO, relative PPO positive. It's telling us that our momentum relative to the S&P 500 is positive. The short-term moving average is above the long-term moving average. So normally what you'll see is this move above just about the time you see the price action move above the moving averages and the 20 start to cross over the 50. When all that's about to take place, you've probably already moved into positive territory on the relative PPO. Consumer staples. I mean, this is perfect illustration. I was talking earlier about how consumer staples have underperformed the S&P 500 throughout this secular bull market. Look at what's happened since April of last year. We're talking 15 months. If you wanted to be more conservative, if you look down here, you'll see the group's gone higher. You've made money, but it's badly lagged the S&P 500. So if I'm in consumer staple stocks, I'd have been better off just leaving my money in the S&P 500 and going golfing. This is not the area, in my opinion, that I want to overweight. How many times has that worked for you? I mean, not very many. And if we pull up, we can do this over the last 8 years like we did the other one. Well, I did 9 years, but we'll still be able to see what's going on here. I mean, you've had periods remember when we went through the trade war and then the pandemic? Yeah, we got some periods where money moved into defensive areas. We went through all that consolidation. Remember 2014, 2015, 2016? We had periods of outperformance, but you do not want to be in when you have these really bad periods of relative performance. And that's usually when the market is at its best. 2016, 2017, into early 2018, the S&P 500 was flying. Consumer staples went higher, but your money wasn't working very hard for you. So you got to be careful. And right now you can see we're in one of these periods where I wouldn't want to touch consumer staples. Now, I do have one thing to say about that, though, and that is that we are less than a week away now from moving into the worst time of the year historically. That's another theme to be considering. A lot of folks say go away in May. To me, that's hogwash. May is not a bad month. June's not a bad month. The first half of July is not bad at all. In fact, the end of June through the beginning of the first two and a half weeks of July are some of the best periods to be in the stock market. I mean, they're among the best periods. Anytime heading into an earnings season, those 3 weeks heading into earnings season, historically, very good times to be in the stock market. But once you get to July 17th, and I've got all the data to support this going back to 1950 on the S&P 500, the worst period of the year, and this doesn't mean we're going to go down. We don't go down every year, but historically, the worst performance in the stock market comes from July 17th at the close to September 27th at the close, which accounts for almost the entire next quarter. So that will be something I'm thinking about when I put these portfolios together. I'm going to want to do well, and I'm going to want to be in technology, but I'm probably going to be a little cautious simply because I know the history of the stock market. All right. Anyway, those are I'm not going to keep going through these individual sectors, but then you've got industry groups. So if you wanted to take, what I like to do is I'll place some bets once in a while. And when I say place bets, I'll take a small percentage of the ETF portfolio and put it into a concentrated area that I think looks interesting. To give you an example, renewable energy. When we were making this big run, we had like a 5% stake in, I think it was TAN, if I'm not mistaken. That was the ETF that tracks renewable energy. And it went up 83% for us in 3 months. So that can really help to spice up a portfolio. Now, this quarter, what I did was the two that I did that with, let me see, one was just financials. It wasn't any particular industry group. The other was defense and aerospace. So let me go through and show you those two. So defense stocks, you can see since this would have been April, so right about in here. Now defense went up. It was doing really well for us. It's come back down. It's about flat, maybe just slightly below where it was. And then aerospace, I think aerospace was kind of similar. But these were two areas that I felt like we probably could get a little bit of boost from reopening. And we did. You can see April and May, again, aerospace doing well, but now we've come back down. So it's probably down slightly from on a relative basis. So they've probably underperformed just a tad. But because growth stocks were not performing that well heading into that April period, it was difficult for me to sit back and just want to go all growth. And so we hedged a little bit. And back in April when we did this, the ETF, model ETF portfolio, and also in May when we did the stock portfolios, I mentioned that I wanted to hedge because I felt like the stock market was going higher, but trying to figure out the rotation and what area was going to lead the market, I thought was really difficult. And I still think it's very difficult. I mean, we're seeing still the difficulty of trying to figure out, is it reopening stocks? Are growth stocks coming back? So we're going to want to hedge a little bit and just be willing to go along for the ride with the S&P 500. If we can outperform, that'd be great. I can tell you, and I'll go over results next week when we announce our new portfolio of ETFs. But this quarter, I think we're down from the S&P like 1 percentage point on the model ETF. But on our stock portfolios, 3 of our 4 are up like 1 to 2%. So I've kind of done what I wanted to do, which was not stray too far from the S&P 500, just kind of put some of the leading areas of both growth and value of reopening stocks versus stay-at-home stocks and just try to put together a blend. And I think that's we've been pretty successful at that. Anyway, I mean, I've got 104 industry groups, so I could go through here and find out, I could look at each one individually, but another way to do this, if you're a Stock Charts member, all of our annual members at Earnings Beats can download these chart lists, these industry group and sector relative strength chart lists into their Stock Charts account, and then you'll have it forever, whether you're an Earnings Beats member or not. We do require you be an annual member just so you're giving us that commitment to download it the first time. But then once you have it, you have it. Unless Stock Charts changes their industry groups, unless something gets split out or something like that, this is good to go going forward. But another way to do this, little tip, if you're not aware, if you go here and click on this View All, and then go to Summary under this View List As, it'll tell you, now this is the intraday, so this was today. This will tell you that automobiles was the best performing industry group today. And then you've got insurance in the second spot, you've got renewable energy in the third spot, investment banking, talk about all over the place. I mean, you can kind of see we got consumer discretionary, financial, technology, another financial, communication services. The good news, though, is that today almost everything was in the aggressive area, many of the leaders. So that's good. But another thing you can do here is look to see what group's been leading over, say, the last week. Coal. Coal's all over the place, very volatile. So I tend to just ignore that one. But you've got real estate here. You've got broadline retail. Of course, that's Amazon. I'd mentioned Amazon's had a really good last week. We could then go out a month. What's been leading over the last month? Footwear. Nike gave footwear a big boost. Computer hardware, broadline retail, autos, specialty finance. If this is starting to sound familiar, many of these groups led last year during the pandemic. Hold on one second, just grab some water. So, we're starting to see a little bit of that money rotating back to some of those large cap growth names. And when I show you the ETF Analyzer, it'll really stand out because I've never seen so many ETFs that all look about the same in terms of their holdings. But those are the ones that have all the momentum right now. It's because Amazon's rolling. It's because Apple started to roll. Now we got Tesla going. Google, Facebook, all of these companies have been performing really well. And that's why many of these large cap growth ETFs are doing so well. But anyhow, this is just another way to evaluate these themes that are, working through the market. Another theme that I'm kind of watching closely are the transports. I'm not quite sure what's going on here with the transports. I mentioned to members recently, this is one of the things that bothers me a little bit about the market in the near term. I mean, we're in the summertime. So I think once we get into this earnings season, it's possible we pull back in the market. I'm watching for signs. Haven't seen any signs yet, definitive, that say, hey, we're topping, but I'm looking for them. If there are two things that bother me right now, it's the fact that transports are not performing well. We got the Dow Jones moved above 35,000, closed at an all-time high today. Where are the transports? Where's that Dow theory? Transports confirming the industrials. Not seeing it right now. So this is something I'm going to be watching for next quarter. Do the transports start to come back? If not, that's not a good sign for the market. Now, you can always just point to one thing always. There's always something in the market that's not right. And so we could always point out one thing and say, yeah, I can't get into this market. You could be saying that for years. You missed the whole secular bull market because you're always trying to find one thing that's just not making sense. The market's so complicated. There's so many things, so many pieces of the puzzle. You're never going to get everything to line up. It's about putting as many of the pieces together as you can and seeing what that is telling us. So yeah, transports, not a good part, not a good sign right now. The other sign that's not very good is this 10-year treasury yield, which has rolled over to a multi-month low. We bounced the last couple of days, but I can show you a chart. We evaluate when I go through and do my evaluation of bull markets, whether it's a mid-year review or start of the year review. One of the things I really like to follow is what's going on with the 10-year treasury yield, because if you go back and you look historically, when the yield is rising, the S&P 500 tends to make its biggest moves. That's all these blue shaded areas. I mean, at this point, you can see here, though, we've been going down recently. Now, it might still all be part of this uptrend. I mean, you can see if you go through just about any of these prior uptrends, here's an uptrend with a pullback, and then we go up again. Here we go up, pull back, up, pull back, up. Here, up, pull back, up, pull back, up. So this could be up, pull back, and another move to the upside. But if it keeps going lower, if you look back at the periods where we have moved lower in the 10-year treasury yield, in a secular bull market, it normally leads to choppiness. We don't normally get hit hard and stay down, but we do tend to be very choppy. Volatility tends to pick up. And it makes sense because anytime the yield's going down, that means prices for treasuries are going up. And if prices in the treasury market are going up, people are getting defensive. And that's not good. Why are they getting defensive? The other thing is if a dollar is going into treasuries, that dollar is not going into the stock market. So every time the yield goes down, it means money is rotating into treasuries. That's money that can't go into the stock market. On the flip side, though, when the yield is going up, treasury prices are going down, and that money rotating out of treasuries is what helps to fuel these big market advances. So it's really important to follow this relationship. I think this is one of the most important intermarket relationships out there, because a portfolio manager can buy treasuries, can buy bonds, or can buy stocks, equities. But they only have limited dollars, and they have to figure out how much they're going to put into each. And so when they start raising their concentration in stocks and getting out of bonds, the yield will go up, and so too will the stock market. So this is something that I think we've got to keep a real close eye on, because the 10-year treasury yield, because it has been, moving lower right here, that's it's a concern. Now we went straight up. Maybe we're going to go back down to this 120 level. And we had a double top breakout. Maybe, and I would say this is, I hate to say worst case scenario, because I really thought 140 might have been the worst case scenario, and we went right through it. But when I look at this big breakout over 1% back here at the beginning of the year, and then we went back and tested 1% before this big move to the upside, I mean, maybe we go back to 1%, but I would be really, really surprised. I'm thinking 120. And if we do keep trending lower, I suspect it's going to be over the summer, when maybe things slow down and maybe aren't quite as crazy as we thought they were going to be. But I think when we get into the fourth quarter, I think we're going to see the market really begin to take off. And historically, that would line up as well. So we'll keep, watching closely for all of our members, looking for the signs that say, hey, you might want to be, rein it in a little bit over the summer. Not seeing those signs yet, but you got transports, you got 10-year treasury yield. You do have a couple of things that are at least worth keeping your eye on. And then the final thing, as far as the themes go, and something I talk about all the time is earnings beats members know, is you can look at growth stocks. This is the iShares Russell 1000 Growth ETF. And you could use different ETFs for your growth versus value. But I use this, and then I also use the IWD, which is the Russell 1000 Value ETF. And so you can see value is going up, been going sideways last couple of months. And then IWF, which had been going up and then pulled back in May, and really it pulled back in February. You can see this period right in here, February to May, it actually went down. And if you look back at the IWD, February to May, here's February, here's May, it went up a lot. So without even pulling up the price relative chart, you already know that the IWF versus the IWD was going down. Growth stocks were underperforming during that period. So let me go ahead and pull that chart up and just show you what I'm talking about here. And I'm going to make it a line chart. So you can see here that, all right, February, especially right in here at the beginning of February, we took this big plunge, came back up, tested this area of relative resistance, went back down, put in a double bottom, and now we're starting to turn back to the upside. So if we lengthen this chart so we can go back a little ways, kind of get a longer term perspective of what happened. You can see we went up, didn't quite get a double top, but then once we started to roll over here, it really accelerated in February, end of February. We put in a double bottom and have broken above that middle point between the two lows. So I think right now money's rotating back to growth versus value. Today was the opposite, value led. So that's what I was talking about. I mean, just the rotation back and forth from day to day, week to week has been very difficult, but it does certainly look like growth is leading, and I would say large cap growth. And I'll explain that when we get to the ETF analyzer here in just a minute or two. All right, the last thing I wanted to point out was and I already did, summertime doldrums, just the market doesn't do well in the summertime. Let me give you some numbers here. No, I don't know if I have that summarized. Let me. I'm going to pull up a spreadsheet on a separate computer. You won't see this, but I'll give you some numbers. All right. One thing I can tell you is that there are 7 periods of the year that I think tend to be very bearish periods. Short-term periods I'm talking about, like week to 10 days at a time. One of those periods starts this Friday at the close, so the 16th. The period actually runs from the 17th close, but of course the 17th will be Saturday. So we're not going to have a close on Saturday. So the close on Friday becomes the close. You have to be careful. And this is, again, not a guarantee. This doesn't go down every year, but the historical tendency is for the market to go down starting on July 17th, or starting on July 18th. So July 17th at the close. Annualized returns on the S&P 500 during this upcoming period, July 18th, minus 28%, July 19th, minus 1%, July 20th, minus 11%, July 21st, minus 40%, July 22nd, minus 12%, and July 23rd, minus 35%. And then July 24th, we actually move into positive territory at 5%. But every one of those days is below the average annual return of 9%. So if every day was created equal, we should be looking at each one of these days I just talked about being up 9% annualized, because that's the average annual return of the S&P 500. But it's not. For the next, starting on the 18th of the calendar month, 18th through the 23rd, all 6 of those days have negative annualized returns. And the period overall in the S&P 500 has an annualized return of minus 21.2%, which is 30 percentage points below that 9% average that the S&P enjoys over the last 71 years. So there's definitely some downside. Now, at the end of July, we strengthened a little bit historically. August is kind of not great, but not horrible. September's bad. September is just bad. That last period when we close out the really rough period, I said through the close on September 27th, the 20th to the 27th, the annualized return is minus 38.89% during that period. So that will give you a sense of, and actually it's September 26th close, not 27th, my bad. But that just gives you a sense of some of the historical weakness that we tend to see. So July, August, September, if the market's going to pull back, in my opinion, if we're going to see any kind of significant pullback or even, a period of consolidation, I think it's coming up. Don't know if it's going to happen, but if it happens, I think it's going to happen before the end of September. I do not believe we're going to see it in the fourth quarter. I think the fourth quarter is going to be strong. All right, so let's move on to the final part of this webinar, which is the ETF Analyzer. So I want to just show everyone first. Oh, I didn't download it in this account. Shoot. We have a strong ETF chart list, but I haven't downloaded into this account. I can show you the old one. I think I have that on here. Actually, this one on this account's really old. But essentially what we do is we provide a list of ETFs. Now, this was back from April, so pay no attention to the ETFs that are in here. But once we run scans looking for relative strength, looking for a certain level of momentum, and once we find those ETFs, we put them into what we call our strong ETF chart list. And then you have that. You can download that into your account. And you can look at it and decide whether or not you like any of these ETFs or you don't. Now, when you look at it on the surface, you just look at it like you do a stock chart. I mean, this is the AMLP, and here's the chart. It's going higher, but this chart doesn't tell me what it owns. It doesn't tell me if it's concentrated or, is it a highly concentrated and maybe just a handful of names, or is it a widely diversified ETF? I don't know. Somebody tells me, hey, this is a great ETF. I just go put it in my account. I have no idea what I own. I know the name of the ETF, but that's it. I don't know what this is holding. I can look at the name and figure, okay, probably energy. But that's about all I can come up with. So anyway, just wanted to point that out before I show you the ETF Analyzer. So we do keep this chart list. You can go through, pull up any of the looking to see if any of these, actually, I know the SMH and the SOX are in the current one that we just updated today. So you can see the SMH. Now you can look at this and say, well, I know it's semiconductors, but again, do you know which semiconductors? Do you know if it's highly diversified or is it concentrated? Can't tell from looking at the chart. So if you're going to buy it, I would at least want to know a little bit more about it before I put my money to work here. And it is a niche. I mean, we're talking about semiconductors, which is a small part of technology. All right, let me go ahead and switch out the charts. And I'm going to bring up the spreadsheet. And John, if you're there, if you could just tell me that you can see this spreadsheet, that would be great.
It's there.
All right, awesome. Okay, so a couple of things about the spreadsheet. So the first thing you'll notice is that the ETFs, when you go in to look at the strong ETF chart list, there should be 50 in there, but you're going to see that there's only 49. And the reason that there's only 49, I don't know, there's something that keeps a, oh, I'm missing a percentage here too. I'm gonna have to update that. There's something that keeps certain chart lists, certain of our chart lists from downloading. We had members write in before saying that, they couldn't get the chart list to download. And for some reason, there's one stock or in this case, one ETF, that if we get rid of it, then everything else loads perfectly in the chart list. Well, that one ETF that we found that was causing the problem was SUSA. So you can see it's part of our ETFs that we list on the spreadsheet. But if you go into your strong ETF chart list that you downloaded today, if you downloaded it, you'll see that this SUSA is missing. You're going to have to add it manually. I've reached out to stock charts trying to find out why some of these charts or some of these symbols create this problem, but I haven't gotten an answer back yet. So for now, we just have to work around it. So we still were able to send out and give you the link so you can download it, but just understand that when you look at it and you see that there are only 49 ETFs, the one that's missing is SUSA. So you can add it manually to your list. That's not going to alter your ability to view anything. But for whatever reason, when we have it in there and then we provide you the link won't work until we get rid of that ETF. So just wanted to point that out, make sure everybody's aware. So what we do here is we list the 50 ETFs. So you got your ticker symbol, you got the name of the ETF, so you can kind of look down and get a general sense of what the ETF's all about just from the name. We also have this column top 10. And what this is it's the percentage holding of the top 10 or the ownership, top 10 holdings of each ETF. So this BUG, Global X Cybersecurity ETF, its top 10 holdings represent 55% of the ETF. And you can compare that to, say, the iShares Russell Mid Cap Growth ETF, where the top 10 holdings only account for 11%. So you can see this is widely diversified. 54% is going to be much more highly concentrated. Here's 70%. So this medical device ETF, top 10 holdings represents more than 70%. So you probably want to look to see what 10 stocks those are before you commit. Make sure you like those stocks. If there's some of those on there you don't like, well, they're going to be impacting your performance quite a bit because this ETF is so highly concentrated. So that's the percentage here. Now, what we do over here is we go in and we put in the total percentage of each of the sectors. So each ETF, for instance, this global cybersecurity, every stock in this ETF is a technology stock. So 100% of the ETFs in technology. Many of these others are much more diversified, like this Fidelity Blue Chip Growth, 37% is technology, 27% is consumer discretionary, 17% communication services, and so forth, all the way across. It's represented by every sector. So it's going to be much more diversified. It's also going to be covering a lot of different sector baskets. And so those who want to be more diversified might find that particular ETF to be better than, say, the cybersecurity ETF, where you have 100% of that money in technology. All right. Now I'm going to come back to this in a minute. I just want to kind of explain how that is done. And then I'm going to take you over to the top 10 holdings. So that cybersecurity that we were just looking at, BUG, you can see the top holding is CrowdStrike, 6.6%. Zscaler, 6.45%, Palo Alto Networks, 5.99%, and so forth. And there's the total, 54.88%. And when you go over here, there's that 54.88%. So you can literally just cross-check to see quickly what stocks make up these ETFs. And remember, the ETFs themselves are only on this list because they've been relatively strong and that their momentum, they've got some pretty solid momentum moving back to the upside. Now, as I go across here, I just want you to take a look at how many of these ETFs have Apple, Microsoft, Amazon, Facebook, Google across their holdings. I mean, here's one, here's another one. This is FDIS, that's Amazon and Tesla, not really that one. Amazon, Facebook, Google, Apple, Microsoft, Adobe, Microsoft. There's CrowdStrike, keep moving over here. Here's Microsoft, Amazon, Apple, Apple, Microsoft, Amazon, Apple, Microsoft, Amazon, same thing. I mean, as you go across here, I kept seeing this with almost every one of these ETFs that were on this list, Apple and Microsoft, Apple and Microsoft. Well, if you look at their charts, they've been strengthening. Apple's been strengthening. And when you've got Apple, that's 18% of an ETF, and you've got Microsoft, 17% of an ETF, that's 35%. If those two stocks are doing well, chances are that ETF is going to be doing pretty well. So as Apple and Microsoft have started picking up the pace again, we're being dominated by ETFs that include Apple and Microsoft. I mean, it's just, I felt like I was, like I was looking at the exact same ETF every time. And you can see, but there are differences. And so you might like the stocks, but you might not want to be that highly concentrated. So you might say, you know what, I like having Apple and Microsoft and Amazon as higher percentages, but I want to get into a situation where maybe these names aren't so heavily concentrated. And so the Schwab ETF, SCHK, top 10 holdings only 24%. You still get a pretty good boost from Apple and Microsoft and Amazon and even Facebook, but then it drops off pretty considerably. And so there are going to be a lot of stocks in this particular ETF. And so I think there's I think this is a good ETF for someone who's looking to try to diversify more. Somebody who loves Apple and Microsoft and wants to make sure that they're getting a really big chunk of those two stocks probably wants to look around here and see, well, maybe these two, 18 and 17%, that's 35%. Maybe those are the two I want. Maybe that's the ETF I want because I want that concentration. But again, if you look at these two, you're not going to probably notice, or you're not going to know without doing a little research, which stocks are part of the ETF, and then also how concentrated is the ETF. So that's, I think, the beauty of doing this ETF analyzer is that it gives us a lot of information that we can then make better decisions on. More information you have, the more educated you are, the better decisions you're going to make over time. I don't think there's any question in my mind. Now, once you do all this, and we're getting ready to wrap up here, for those of you who are wondering how long it's going to go on, this is just the last couple minutes. The last thing I want to just point out that what we do is we type in up here the S&P 500 percentages by sector. So the XLK currently represents 24.22% of the S&P 500. The XLY is 12%. The XLC is 11%, and so forth, all the way over, and all the way to the material side. So that'll give you a general sense of what, how much is in each sector within the S&P 500. And the reason this is important, if you go back to what I said at the very beginning, technology has been the best performing sector by far during this secular bull market. So you may want to overweight. So when you put your sectors or your ETFs together and put in the allocation percentage, which I'll show you in just a second, you probably are going to want to see this result come up more than 24.22%, which probably is not going to be hard, seeing as just about every one of these ETFs is heavily concentrated in technology. And by the time we do this next week, I might change this up a little bit just so we can get some other ETFs, because many of these ETFs are just looking like large cap growth. I mean, if you look at the names, there's your blue chip growth. Here's large cap growth, mid cap growth, top 200 growth, global tech, US tech, mega cap growth, large growth. We talked about themes earlier. If these are all the ETFs that are coming through under the scan that's used to pick up relative strength and momentum, I don't think I have to really go looking to see what's leading the market right now, or what's been leading the market, say, over the last month. Remember that relative strength on technology chart that I showed you, where it's just turned right back up again. Consumer discretionary turned right back up again. The large cap growth names in those sectors is what's driving the stock market right now. And this is proof of it. I mean, this confirms it. But just, just to say we did it, let's do a couple of things here. I'm going to try and get some of these widely diversified ETFs. Like this one's only got 12.6% in its top 10 holdings, and it's mid-cap growth. Let's say one of the themes is I really like mid-cap stocks. So let's go ahead and put 20% in this particular portfolio or in this ETF. And then let's find another widely diversified, that's mid-cap growth. I don't want to do mid-cap again. Let's find large cap. Here's large cap equity, only 22%. So this is going to be widely diversified. Let's say I want to do 20% here. Now let's say for some reason I'm really feeling strongly about real estate. And let's say, it's over the summer months, want to be a little bit more defensive. So therefore, I want to put 10% directly into real estate. Now, when you look over here, you can see real estate, it's 100% in the real estate sector, which makes sense because it's a real estate sector ETF. So all 10% of this is going to bump up our real estate holdings. So let's see, Wisdom Tree Cloud Computing. This is mostly technology. Let's just do 10% here. Let me see. Let's say financials. What's high in financials? 32%. This one's 32% financials. So let's put 10% in here. So now let's say, okay, I think I'm done. I think that's 100%. Well, if you come up here, it'll tell you error. Why? Because you only have 70%. If you add up your allocation percentages, I've only put in 70%. I need to have 100%. Must equal 100%. So we have an audit built in here that, we can kind of follow. Let's see, what else do we want to get? Let's say we want to zero in on, technology, consumer discretionary, and communication services. These are the three sectors that have done the best over the last 8 years during the secular bull market. So the fact that this has 90% in these three ETFs or these three sectors, maybe this is an ETF. This is the Internet Index Fund. Maybe I want 10% in here. That would be getting more aggressive as opposed to some of the other where I've been pretty conservative. And then we still need, let me just pick one, 20%. Here's a Schwab 1000 index ETF, very diversified. Let me just put 20% in there. And I did that just so I have 100%. So now, no error, 100%. And what you can do, look at the yellow highlighted area here. So what I just put together, it calculated that I now have 33% of technology. And I have 9.5% in consumer discretionary. I don't know if you all are hearing this lightning and thunder. Well, you're not hearing lightning, but thunder. But I've got a pretty good storm going here, so hopefully I don't lose you. If I do, we're just about done anyway. Anyhow, you can see in the yellow shaded area how much you've put in these different areas. So you can see you've definitely overweighted the technology area. You're more than 8 percentage points above the S&P 500. So if technology does well, you've got a better chance now of outperforming the S&P 500 being in that. The other thing you can see is by doing that real estate, putting 10% into that XLRE, 12.3% is in real estate as opposed to 2.5% on the S&P 500. So 10 percentage points. So if real estate underperforms, that's going to hurt my performance because I'm making a bet on real estate. But I think it's pretty cool because you can put together your portfolios, your ETFs, however you want within your portfolio. And this will help you to understand what you own. Now, let's say you want to get into an ETF and it's not on our list. Well, we gave you room down here. You can come down and you can enter whatever ETF you want. You can go look on Yahoo or maybe Fidelity or somewhere, get your percentages in each of the sectors, and then you can include this as well. So it doesn't have to be just the ETFs that we've picked. You can go in and put your own in here as well if that is something, let's say you want to pick 5 from here, but you have 2 other ETFs you really like, and you want to see what that does to your weightings. You can go ahead and add those 2, and it'll update it for you. All right, I'm afraid I'm going to lose you all here. This storm is pretty rough, but let's go ahead and wrap this up. John, if there are any questions, I'll try to answer them really quickly. What do you got?
Yeah, let's see if we tackle just a few. Will you please, the question is, will you please list the sector ETFs with percentage returns quoted?
Can
Can you
say
make
that
sense
again?
of that? Will you please list the sector ETFs with percentage returns quoted?
Well, percentage returns over what period? I mean, I'm not
Doesn't
sure.
say. All right,
Yeah,
let's move. Yeah.
I mean, once you have these ETFs, and you have this strong ETF chart list, you can do what I did earlier and just go in and go to that summary and look at the last month or 3 months, and it'll tell you how these have done over certain time frames. So you can do that without it being on this spreadsheet.
Okay. In terms of XLP, the ETF itself is underperforming the SPX, but Costco is doing great. So how do you consider the individual stocks?
Well, I mean, you can still get individual stocks in some of these. I mean, they're not all sector concentrated ETFs. Many of them have stocks that are in many different areas. I believe, I'm not positive, I'd have to go and double check it, but I think on Fidelity, they have something where you can type in a stock and you can see which ETFs that stock is included in, and I think even maybe list it in order. So in other words, if there's an ETF out there that says that maybe has 7% in Costco, I think you can find it on Fidelity, but I don't think I'm making that up. I think I saw that one time, but I'd have to verify that.
A couple more quick ones. During stock screening, if AD chart is going up, stock versus industry group is going up, then do we need to worry about PPO if it is below zero? Quite a question.
Well, I think you said AD chart, but I'm guessing that's AD line.
Yeah, AD line, I'm sure.
I'm not really following the ADs on ETFs. I've never really studied it, so I wouldn't be comfortable saying that I would be interested looking there. I do think following the ETF relative to the S&P 500 is a good idea. And this latest chart list that I put out there today does show in the bottom panel the relationship of that ETF versus the S&P 500. I think relative strength plays a big role. So I would be interested in the relative strength for
All right,
sure.
let's wrap up with this one. Maybe have a value ETF to add to mixture since we keep having rotation.
Well, value, if it's in, when value's in, when momentum is favoring value, we're going to see it in this. Now, I did see there was one ETF that I looked at. I was wondering why it wasn't included. It was a small cap. Whoa, okay. That one almost hit the house.
I can hear that.
Yeah.
Should wrap it up.
There's a small cap ETF, PSCE. It's a small cap energy that's been doing really well, and I was surprised it wasn't on here. And when I looked it up, it's been consolidating, and the PPO fell below the level I used in picking up the ETF. So I said earlier I might do something a little different between now and next week to try and get some other stocks or some other ETFs in here, and that's what I meant. So I'll be looking at that.
Okay, I think it's a good time to wrap up. I want to make sure everybody knows they'll get a copy of the recording. And again, if you're new to Earnings Beats, you should really think about taking out a trial, no cost trial. Just go to our website. It'd be easy to spot. And join the Options Max Pain webinar tomorrow night, Tom. That should be great.
Yeah, it should be good. And also, we generally, and I'm going to pull up one more thing for everybody, because we do have a webinar special that we always have, and this goes through Wednesday. We have a number of webinars coming up this week, including Max Payne tomorrow. But we're running this special. So if you are new to Earnings Beats, or if you're a trial member, or even if you're an annual member, you can use this special to extend, become an annual member, or just extend your current annual membership. You get 13 months for the price of 12. If you're just a monthly member, or you're a trial and you go to monthly, you're going to pay $147 a month. But you can get an annual, and in this case, 13 months for $997. So you'll save a ton of money. So check out the webinar special. If you go to earningsbeats.com and just at the top of the page, you'll see webinar special. Click on that. If you have any problem signing up, just email us at customer service at earningsbeats, or no, support, I'm sorry, support at earningsbeats.com. And we'll get back to you and make sure we get you squared away. But if you haven't tried our service, do it now. Do the 30-day trial. There's no cost at all. And you'll be able to come to our Max Pain webinar tomorrow and really get to experience us for 30 days, that'll take you through next week's draft of the model ETF portfolio as well. So appreciate everybody tuning in. I'm going to get out of here before I get shocked. But everybody have a great rest of your evening, and be back tomorrow evening with your next webinar, Max Pain. Take care. Happy trading.